While most investors chase charts, smart money follows strategy. While the public debates headlines, corporate raiders move silently behind closed doors. They don't gamble. They don't guess. They engineer profits. Decades ago, corporate raiders took control of companies by exploiting weakness, fear, and timing. Today, that same playbook is still being used, not just in boardrooms, but in the financial markets you trade every day. Ever noticed how price moves before the news breaks? How a stock quietly rises, then suddenly everyone is talking about it? That's not luck, that's positioning. In this video, I'll show you why price always moves before the news, how institutions quietly accumulate while retail investors are distracted, and how you can legally copy the mindset of corporate raiders without insider information, without shortcuts, and without hype. Because once you understand how smart money really plays the game, you'll never look at the market the same way again. To understand how smart money moves today, we have to go back to where this strategy began. In the 1980s and 1990s, a small group of investors changed Wall Street forever. They were known as corporate raiders. Names like Carl Icahn, T. Boone Pickens, investors feared by CEOs and closely watched by regulators. But here's what most people misunderstood. Corporate raiders weren't villains. They were strategists. They didn't buy companies because they loved the brand. They didn't invest based on emotion, loyalty, or public opinion. They searched for weakness. Over-leveraged balance sheets, undervalued assets hidden on financial statements, poor management, inefficient operations. Their goal was simple: gain control, force change, exit at a profit. They would accumulate large positions quietly, pressure management, restructure, sell assets, or push for buyouts. Corporate raiders didn't ask if a company was popular. They asked if it was vulnerable. And once that vulnerability was exposed, value was unlocked and the exit was executed. That same mindset, exploiting imbalance, timing fear, and planning exits, is still alive in today's financial markets. Only now, it's called smart money. The market isn't divided by rich and poor. It's divided by informed and uninformed. On one side, smart money. On the other, dumb money. Smart money is made up of institutions, hedge funds, market makers, and large insiders. They don't react to the market. They prepare for it. They buy before the news. They accumulate quietly while price goes nowhere. They use time, leverage, and influence to shape outcomes. Smart money doesn't rush. It waits for maximum advantage. Retail investors, on the other hand, are trained to react. They buy headlines. They chase green candles. They enter after the move is already obvious. And when the market pulls back, they panic. They sell at the worst possible moment, right when smart money is buying. This is why the same pattern repeats every cycle. Retail provides liquidity. Institutions extract profit. By the time CNBC tells you, smart money is already exiting. The goal of smart money isn't to be right, it's to be early. And once you see this divide clearly, you'll understand why most traders lose and why a few always win. Every major move in the market begins the same way, not with excitement, not with headlines, but with silence. This is the first and most important strategy corporate raiders mastered: accumulation before attention. Corporate raiders never bought when everyone was watching. They bought when nobody cared. Low volume, boring price action, no news, no hype. To the average investor, these charts look dead. To smart money, they look like opportunity. In modern markets, the strategy is the same. Only the tools have changed. Smart money accumulates during sideways price action, while volume quietly increases in the background. This tells you something critical. Large players are buying without pushing price up. Another signal? Insider buying. When executives buy their own stock, not with options, but real money, they're telling you the company is undervalued. And when institutional ownership starts increasing, that's smart money building positions patiently. They don't rush, they don't chase, they let time work for them. Smart money doesn't need excitement, it needs silence. And when attention finally arrives, price moves fast. By the time the crowd notices the move, accumulation is already over, and the next phase begins. Most investors believe markets move because of news. Smart money knows the truth. News follows price. This is the second strategy corporate raiders mastered. They didn't just buy stock, they controlled the story. Once corporate raiders built large positions, they influenced management. They pushed for restructuring, asset sales, leadership changes. And when the time was right, the narrative changed. Strategic leaks, optimistic projections, sudden turnaround stories. The company didn't magically improve overnight. The groundwork had already been laid. In today's markets, retail investors can't control management, but they can read the signals. Form 13F shows you what institutions are buying and selling. Form 4 reveals insider transactions. When you see major funds building positions, when executives are buying, that's smart money shaping the future narrative. Watch activist investors closely. When they get involved, change is coming, whether the market likes it or not. And be especially alert to sudden analyst upgrades, after price has already started rising. Price moves first, stories come later. The crowd believes the story caused the move. Smart money knows the story justified it. And once the narrative is fully embraced by the public, smart money prepares for the most important phase of all, the exit. Most investors spend all their time thinking about entry. Corporate raiders think about something else first, the exit. They never entered a position without a plan to get out. For corporate raiders, exits were engineered events, IPOs, buyouts, asset sales. The entry created control. The exit created wealth. In today's market, smart money follows the same rule. They don't sell because price dips. They sell when conditions are perfect. One of the clearest exit signals is distribution, when price moves sideways at the top while volume explodes. This is smart money unloading positions slowly, without crashing the price. Another warning sign? High-volume sell-offs after good news. When earnings beat expectations. When a major partnership is announced, but price starts falling. That's not bad luck. It's smart money selling into retail enthusiasm. When retail hype is at all-time highs, smart money is already gone. If you don't know where you'll exit, you're someone else's exit liquidity. Markets don't top because news turns bad. They top because there's no one left to buy. And when smart money finishes exiting, fear returns, creating the next opportunity. When fear enters the market, most investors freeze. Smart money leans in. This was one of the most powerful weapons corporate raiders ever used. They bought companies when lawsuits hit, when scandals dominated the news, when markets crashed and confidence disappeared. Not because they were reckless, but because fear forced mispricing. Panic pushes prices below reality. In modern markets, the opportunity looks the same, only the setting has changed. Broad market corrections shake out weak hands. Sector panic does the same thing. When everyone declares a sector dead, that's when smart money starts researching. And then there are forced selling events, margin calls, ETF rebalancing, fund liquidations. These sellers aren't exiting because value disappeared. They're exiting because they have no choice. That's where smart money steps in. Fear creates discounts. Smart money shops during chaos. By the time fear fades, positions are already built. And once you understand how fear is weaponized, you stop fearing the market and start using it. Now, here's the part most finance videos skip. This strategy isn't magic, and it definitely isn't overnight wealth. Thinking like smart money doesn't mean instant profits. It means patience, discipline, and the ability to wait when others can't. Sometimes accumulation takes months. Sometimes nothing happens at all. And that's where most people fail, not because the strategy is wrong, but because waiting is uncomfortable. It's also important to be honest about one thing. Institutions still have advantages. They have more capital, more data, more access, and more influence. You can't out-leverage them. You can't outspeed them. But you can outlast them. Retail investors who survive are the ones who stop reacting and start thinking in phases. Smart money wins not because it's smarter, but because it's calmer. The goal isn't to beat Wall Street at its own game. The goal is to understand the game well enough to stop being used by it. And once you adopt that mindset, everything about how you see the market changes. Here's what smart money teaches us. Accumulate quietly. Follow filings, not feelings. Enter boring, exit euphoric. Every move should have a plan. Every trade should have a purpose. Every risk should be calculated. And remember this, the market isn't a casino. It's a battlefield. And corporate raiders wrote the original war manual. Think like a raider, act like smart money, and you'll never look at the market the same way again. Like, subscribe, and comment. Are you ready to think like a raider? If this video changed how you see the market, hit like and show your support. For more financial truths Wall Street doesn't teach, subscribe and turn on notifications. You don't want to miss the next strategy. And I want to hear from you. Comment below. Are you trading the news or following smart money? Your insight could spark the next big discussion.